Okay, this is the Advanced Family Law webinar, Family Law Software webinar. We're going to be talking about taxes and tax reports in the program today. I have my colleague, Anna Tate, also helping me on this webinar today, and she and I will both be monitoring the Q&A in the chat. If you have questions, if there's anything that you have a burning desire to know about taxes and want to make sure we cover, you can put it in the Q&A, or if you wish during the presentation, if something comes up, please put your questions in the Q&A. I know you will have questions. We will try to get to them all, but we do have a lot of material to cover today, so let's get going. Family law software has a tax engine built in behind the scenes that's really very accurate and amazing. The family law software program was created by the developers after they had developed and sold a program for tax return preparation to H&R Block. And H&R Block, they are still using that program, the original code today, in their desktop software. So the behind the scenes in this family law software program is all of that tax knowledge. And just like tax preparation software, everything is sort of built in there. Of course, taxes are important in all aspects of divorce financial analysis. Child support in many states is based on after-tax net income. Property division can be impacted by tax ramifications. There's untaxed capital gains. There's retirement assets that are tax deferred, and trading those off or distributing those without really considering the tax implications means that your client may be getting more or less than they're entitled to. Alimony, even now when it's not federally taxable and deductible, some states still allow the deduction or call it income. And those states generally have higher tax rates. So that's still going to be significant if you are in one of those states. And we do take that into account, as well as looking at net income. We have projections and assumptions in the program, which will include tax implications. The good news is Congress didn't do much this year. They haven't passed any bills that significantly impact our family law cases. So let's start with looking at the program and net income. I'm going to share my screen. And this is the program that is the cloud-based program. And yes, we'll try and get to equity compensation division if we have time, but definitely the tax implications on income and property are part of our program. Okay, so now let's talk about the program itself. I'm going to log in, and I don't have a case file loaded. I'm going to start a new case just to show you some tax things. We're going to just say Joe Smith and Jane Smith. And we'll say that they're in Illinois because I'm in Illinois and I'm more familiar with that. And we're going to call this the Smith, let's say, tester file. And I'm going to create that new case file. So now we're in December of 2022. But if I look at my settings, including my assumptions, you will see that the program is already starting with the tax year of 2023. Starting in about mid-December, we're going to set the tax year for the next year, because most of the files you're going to open now, you're really going to be working on in 2023. You can always change, excuse me, the tax year. And when we go back We're going to talk about this later in terms of the tax year. Setting the tax year, you can go to the assumptions, or you can go to reports, more reports. And at the top of the page, we have the start year, both on the lawyer's page and on the planner's page in the assumptions. Okay, so on the lawyer's page, it's at the top and it's in the assumptions. So now I'm going to open up another file with some data in it so I can play around with some stuff for you. And this file now is an existing file, so it's going to have as the tax year 2022. And I can change it if I want to move forward, roll it over to next year. After the first of the year, when I reopen this file, it's going to ask me if I want to change the tax year. And so your existing files, when you open them in 2023, the first thing will pop up is, do you want to change the tax year? And that, of course, you cannot change it if you want, but it's easy enough to just click yes, and it'll advance the tax year. Now, let's start talking about net income. So that in our program is income after estimated actual taxes. Child support, like in Illinois, that's based on net income, is going to automatically have the tax consequences taken into account in computing child support. And that's true in any state that we do computations of child support. There are 22 states. And then those states that don't have net income obviously are not going to use the tax implications. So as I put in my wages and my wage-like income, I am going to put in the gross amount. Remember, of course, that you want to use, if you're working off, let's say, a W-2, you want to use the wages that are the Medicare wages, not box 1 or box 3, but box 5, because Medicare taxes on all the wages. Social Security only taxes on up to a cap. So your Medicare wages could be a different amount in a high income case. So you want to make sure you use the right information. And then we are also going to be looking at the deductions. So if, for example, I put in an asset of real estate and it has a mortgage, we're going to automatically calculate the mortgage interest. You will see here in this existing file that it's showing an annual interest rate of 3.5. I entered that information. In a existing file, when this file was created, the interest rate was 3.1. If you created a new file now, it would be using a current interest rate, but you can always change it. And if you click on the help buttons in any part of the program, it will give you more information about this piece of data. Okay. And if, for example, there is going to be a different child support, let's look at a different state. For example, if I change this to, let's say, New York, and I go back to my enter data, now my support maintenance data is going to use the New York state taxes. And I'll talk about that in a minute. And then it will also use the provisions for the New York support obligations. So there's a statutory cap in New York, or you can use a higher cap or don't use any cap, considering all the income. So we have very state-specific things in the program to make that accurate for your state. We also are going to look at budgets using tax consequences. So this is important, and I'm going to go to reports and look at the budget report. if you're trying to help your client have a true picture of what their needs are going to be post-separation or divorce, and if we're going to be looking at tax consequences, to look at what their true net income after taxes is going to be. And this could be after taxes and support. So we've included the support paid and received in these budgets, or I have a setting for this report where I cannot include the spousal maintenance and child support, maybe early in the case when you haven't set that yet. And now our net incomes are going to be different. And you can see here Taylor, who hopefully will be a maintenance recipient if you represent her, is in the negative, and Blake here is an excess per month. So, and we can look at these on a monthly or an annual basis, and we can look at one party or both. And then this will give me an annual number as well. So given that information, we have the other reports as well, in more reports, especially in the planner section, that will allow us to look at the cash flow. So here's net income after expenses and taxes. And this will go out as many years as you set it to go out. Here I have it going out like 50 years. And it will give you a whole rundown of what all of the information will be all the way out into the future. As well as we have reports that will help you look at tax detail. And we'll look at that in a bit. In the projections that the program does, we have an application of accurate tax obligations to be paid, which is crucial to arriving at accurate estimates of future income or assets. So I can go into, for example, I'm going to go here and look at some graphs that we have in the program, one of which is a projected net income after expenses and taxes. And we can look at that and say, how is this settlement going to work for our client or the other side, whichever ox we want to gore. And excuse me, we're going to see that here, in this case, Taylor is going to be pretty much at or above the line, but Blake is going to be way up there in terms of his growth. So maybe if you represent Taylor, you don't like this proposed settlement or this proposed arrangement. We can also look at assets used to cover net income, as well as, and that's in a graph. We can also look at it in a report. So I can look at the projected net income after expenses and taxes. This is the graph that we just looked at, and this is going to give me the numbers. Sometimes it's easier to see it in graph format than in the numerical table format or spreadsheet format. And certainly clients will and judges will respond to the pictures often more than the numbers. We can look at liquidations to cover net assets in our reports. Whoops, there aren't any here because there's lots of numbers. Liquidations to cover net cash flow, if there's going to be reports, and there are settings in the assumptions for how this is going to work. And in order to do that, of course, you need to have accurate taxes. Okay, now we also have the situation where people's tax situations change a lot in divorce, in part because their income changes, And in part because they go from filing jointly to filing single or head of household, many people are using last year's tax return to determine what income is going to be, what support is going to be. But that can be very wrong, both for calculating child support and for budgeting. So if I go to the enter data and I'm looking at 2022 information, and again, whether they're in a relationship again or not, I can go into parties and children and go into the detail for a party, and it will ask me what's their tax filing status in 2022, and then what's their tax filing status in future years. So if in 2022, they're going to still be filing jointly, but next year they're going to be head of household, their taxes will change significantly because of that information. And then we can go into a tax report. Into a tax report that will be very easy to see what that difference is. So I can go into my reports and I can go to view edit taxes. And this is going to tell me right now they're filing jointly. But if I move us ahead to 2023, they're filing separately. It tells me what their tax filing status is, and it will tell me what their taxes and their tax rates are on this report. I like to also use that report for other purposes we'll talk about later. So you can set tax filing status for the current year and future years. Remember that head of household filing status is independent of who gets the dependent exemption. You can allocate and assign tax dependent exemptions. You cannot allocate head of household. That requires that a dependent live with the taxpayer for more than 50% of the overnights. There are, of course, other tax filing statuses. You've got single, married filing jointly, married filing separately. And in our program, we can do married filing joint with a new spouse. So when I'm entering the data and I go to parties and children again, one of the choices would be joint with new spouse. So that enables you to also put in your income information, new spouse's income. So if I go to support and maintenance data and I go to wage-like income, sorry, scroll down too far, I can have new spouse income, which only includes that income for tax purposes and not for support guidelines. But it does impact the taxes if you are in a net income state. So it would impact the support guidelines because they may be in a higher tax bracket with both incomes. Okay, now state tax rates. The default setting is the state of filing, but it can be set differently. So again, if I go into parties and children and I look at the state of filing, that's the state that you're going to start the case in. And when you open the case, like I showed you a minute ago, opening a new case, I'm going to say what state. If you've already set your current state, that's the one that's always going to come up unless you change it. Okay. And then the state where the party lives, here I've got them living in New York. But what if, for example, Blake is going to, let's open up Blake's other party. I can say that Blake lives in, let's say he's going to live in Connecticut. So now that Connecticut is going to be used to calculate state tax. And of course, if they live in another state like Florida, where there is no state tax, we're going to use the no state tax of Florida. so you don't have to make any adjustments. For those of you who were FinPlan users, you always had to make an adjustment for state taxes and calculate what that would be. We don't have to do that in this program. It will be automatic. I'm going to set this back to New York for our purposes. And then let's talk about state tax rates. The program has reasonable tax estimates for all 50 states and Canada. For clients who live in different states than the case is in, you should make sure to set the state taxes appropriately. So I showed you the tax year, and remember that we're going to be using the current year. You can always change it. So it rolls over for new cases in mid-December. So if you open a new case now, it's going to show you 2023 taxes. And that really is before any tax software for 2023 is available. We're already using 2023 taxes in new cases now. And then in January and beyond, if the case was from a prior year, you're going to get a pop-up. It is okay to say no and keep using the prior year. Just be aware that taxes may be different. Remember that if you're trying to calculate support or something for a past year, so let's say that you've got a case where somebody didn't pay the right amount of support and you want to go back to 2017, you can always do that by going into settings, and under assumptions for the tax year, you can change it to any year, and it will have, in the last 50 anyway, and it will have the tax appropriate computations for that year. So what I do if I'm doing past years is I will set the tax year for a prior year, and then I will do a save as. I'll go into File Manager and say, copy the program and make it a 2017 Smith file. Smith 2017, Smith 2018, Smith 2019. So I have a separate file for each year because you're going to be changing income and all the other settings. But if you're copying it, then all the stuff that is the basic data, like in parties and children, will carry through. And if you put in the birth dates of the children, it will automatically calculate their ages. So the program will know whether they qualify for a dependent status, whether they qualify for tax credits, all of that. Okay, remember that taxes change every year, federal for sure, and some states change their taxes every year. Some, like Illinois, are a flat tax rate, and we haven't changed in a couple of years. And we had one year a couple of years ago where we had 3 different tax rates in a year. But IRS issues new tax tables every year. So tax brackets for income change every year. And that could also impact capital gains tax rates because the brackets for the capital gains tax also change. Earned income credit tables change every year, and this can affect net taxes. So as we are looking at, let's go and look at the View Edit Taxes report, you will see that we have the deductions, we have tax credits, including the qualified business income deduction, and we also have like the child care credit, the American Opportunity Credit, the Lifetime Learning Credit, the child tax credit. All of that is already built into the program. And we even have the phase outs and the earned income credit, all of that. So we have refundable credits and non-refundable credits. And those change with the phase outs every year as well. State taxes, federal tax rates are usually updated in December for the following year. We already have 2023 in the program. State taxes won't be updated until February although some states are very slow to publish new rates, like California, usually takes till summer or even fall to get their tax rate updates. So on that view taxes page that we're on now, this is actually a pro forma tax return for the current year. And if you select as one of your options to look at future years, we will have the tax information for future years as well. So what does pro forma mean? If the information entered into the program is accurate, this page will show what their tax return will look like. It's also a good page. I use it to double check income and taxes, especially if there's an anomaly. If I see something on the results on the reports that doesn't look right, wait, child support shouldn't be that number, or I don't understand how net income came out to that when in my brain I estimated it as something different, that will tell me that there's something wrong. I did something wrong. So I can look at this page and I can see, oh, wait, I put capital gains for both parties. I split it somehow and I wanted it all to go to Taylor. Or I put this business income on Blake's column. I meant to put it on Taylor's column. So then I can just go back into the data and I can change the allocation of that asset. Or I can go into another page. I can either go into the data to change it, or I can go into analysis into my divide property worksheet, and I can change who's getting the asset. Here's the business, and I can change that it's going to go the other way. And now the income from the asset will go that way also. We have a couple of questions. Am I correct to assume that FLS programs for existing tax laws, future tax changes if they are currently written in the law, and that past, if their existing tax law applies in perpetuity? Yes. So for example, the Tax Cut and Jobs Act changes that were enacted in 2017. If I look, let me go to the view edit taxes, and I'm looking at 2023, and you can see that the tax deductions are $13,850 for Blake and $20,800 for Taylor. If I move this forward to 2026, after those changes have ended, you will see, whoops, went too far. Sorry about that, giving everybody whiplash here, that now Blake's tax deduction is $30,000. His went way up, and only $11,500 for Taylor. There may be other changes, a kid emancipates or something, excuse me, that would have changed her taxes, but this will be accurate. Now, if Congress changes that again, and 2021 is a good example of a weird tax year where we had all those crazy tax credits and the recovery rebate, all of that is built into the program, and they are elections to include or not include in support, by the way. So you can go out into future years. Any tax law changes in the program will already be in, any tax law changes in the law are already in the program. And of course, when Congress changes the law, which I'm sure there will, they will change that. Now, one thing I should tell you is that if you're waiting for alimony deduction to come back, I have it on authority that there is no appetite for that in Congress. So we shall see things change. But unless we start lobbying heavily and Congress or the IRS changes their mind on that, that's not happening. The alimony deduction is probably dead for good. Okay, so now let's look at another aspect of taxes, which is for property valuations. So if I go into the analysis section, this I call the playground or the sandbox of our program. This is where you can work with different options and look at different perspectives on the program. Then you can go into the property section. Now I've divided property, right? But I want to see what the after-tax implications are. So I can go to the property after tax. Now, this is not going to be your results unless you print this as your results, and you can PDF any page in the program. But what we're looking at here is two different tax perspectives. So this calculation estimates the percent of the value that will be paid in tax when the item is sold or the account is distributed in retirement account terms. After-tax value is simply the pre-tax value minus the tax to be paid, right? We all understand that. So this allows us to do an apples-to-apples comparison of pre-tax assets like appreciated stock accounts, retirement accounts, and after-tax assets, which will allow us to look at trading off assets that might have a different value after tax. This shows the percent of tax to be paid in tax for each asset. So let's look. We have two different pictures. We have marginal tax rate at retirement, and we have capital gains. So those are the two things we're solving for in this report, in this worksheet. And here we have our balance sheet with all of the assets listed, their 100% values. Whoops, I want to do the whole row. Here's the marital equity portion, the 100% value of marital equity. We have the split and the resulting value for each party. And we are taxing those things which may end up being taxed. If you have, so we're showing all the calculations, by the way. You can override if you think that this property is going to have tax, but not at this rate. You can override it and put in the right amount, or in your mind what it's going to be. And if you override, it's going to turn red. You can always go back to the original value by just deleting your override and then hit tab or enter, and it'll go back to the original value. Let's explain each of the scenarios. The software shows all its calculations, the tax rates to apply for capital and retirement. So these are the tax rates which are going to be applied at the top of the page. And then percent of tax for each asset. And that's in the middle of the screen. And then we have a detailed explanation. So we can look at this detailed explanation for each asset and what that tax calculation is going to be. And the program knows whether things are capital gains or ordinary income, like retirement accounts, deferred income. So if you were going to have equity compensation like deferred comp, that's going to be taxed later, this would be able to show that. Okay, so Lori is asking, I get pushback when using the marginal tax rate. How are we supposed to estimate effective tax rates? Okay, so if you go to the report and you go to the View Edit Taxes report, we actually will tell you what the marginal tax rate is, which is in the middle of the page, the marginal federal tax bracket. So marginal rates, for those who maybe don't know, are the last dollars in questions. And then we also give you the average federal or effective tax rate. So that's on this report. And you can always refer to this report to look at it. Okay. And Anna, did you want to say anything else?
No, I think that was really helpful. It looks like Lori found that helpful as well.
Okay. All right, good. And now we also have, as we were going back to, let's go back to the analysis and property after tax. This is also going to be able to look at the equity for capital gains. Now, to determine capital gains, we're looking at current income to determine the capital gains tax rate. So the program is assuming that the asset is going to be sold in the current year. There are some assets that, like a house, that will enable you to show it in a future year being sold, but that really, generally speaking, houses are not going to have too much capital gains because of the favorable tax treatment for primary residences. And of course, there are different capital gains rates depending on income. The capital gains rate also includes the net investment tax, if that's applicable. It's not capturing the possibility, though, that the capital gains themselves would push the party in a higher tax bracket, or a bracket where the NIT, the net investment income tax, would apply. So you may have to adjust it yourself that way. But it's very easy to forget the tax effect of dividing or allocating assets with untaxed capital gains. And that can really hurt a party if they're unaware. They think they're getting an account with, let's say $400,000 in it, but there's untaxed capital gains in there, and they're not really getting $400,000. They're getting $300,000 and a $100,000 tax bill. So that is important for our clients. We are also looking at retirement. So for that, we're looking at income tax rates, because remember, retirement is taxed as ordinary income when distributed. And that also requires assumptions. It requires the assumptions of what income will be at retirement and when retirement will occur. And of course, those are estimates as well. So those assumptions for retirement can be set. We're going to first look at parties and children, and we're going to go into the parties and children, and this will let us put in the date of birth, right? So that will help the program determine when retirement will occur. Generally, it'll be at full retirement age. And then we can look into the wages, as I'm just going to go here for wages because it's a little easier. And I'm going to go into wages, and I'm going to go into more info for wages. That's the green box with the 3 dots. And here we will have some fields. In New York, it's at number 10, the age at which you guess Blake will retire. So we're going to do full retirement age, which is 67 now. Okay, normal retirement age, but you can change it. And then if you have the birth date, it will automatically figure out when that retirement will start. So if I changed his birth date, it would change when retirement started. Or if I say he's gonna work till he's 70 and get that extra bump in Social Security payments, 8% a year, not bad. You're going to get that change in the retirement income assumptions. Okay. And then there's also assumptions about inflation rates. So for that, we would go into settings, assumptions, and we have an inflation rate assumption. Now that assumption, of course, you're going to look at this and say 2.4%. Well, this file was created several years ago. And what we're looking at is we're going to use that inflation rate on this old program, but we update it once a year. So if I went into that new file that I just created a few minutes ago, and let's go into Smith Tester. And now I go into settings assumptions. Our assumption for inflation rate is 2.2. Why? Because that is what the CBO has said their projection of inflation over the coming 10 years. And of course, that CBO rate is what the Fed Reserve is seeking to accomplish with their rate hikes to get us to that 2.2. So that's what the CBO uses. You can always change it. 7%. That's what it's been this year, right? Or that's what it is currently. You can always change it, and it will change all the results of those assumptions when you do that. Reopen that other file that we were working in because it has more data than this brand new one that we, the question is, why not use a historic average over the past 30 years? Because, Anna, would you like to answer that?
That is a Dan question or a developer question.
Well, I'll tell you why. Because we're doing projections and looking at interest rates over the past 30 years are as much of a guess of how that's going to apply going forward as looking at the CBO numbers. You can always change, as I said, that assumption rate. And for those who are financial planners on this webinar, you're going to probably want to do that. For the lawyers, it's not going to make a ton of difference unless you're really looking at all these projections and using them. Okay. And you can always explicitly set capital gains and marginal income tax rates for retirement in that report. So again, analysis, property after tax. And then when I go up here, I can, all the way up, I can change these settings as I choose, and I can go into an explanation and it will explain how that is calculated. And if you feel like you need to change it for more accurate projections for yourself, for your clients, you can do that. The one thing, and I'll just give you this disclaimer, the rates are calculated by estimating the percent of total value that will be paid in tax. Non-retirement assets are assumed to be sold today and subject to current rates. Retirement assets are assumed to be distributed at retirement and subject to the marginal tax rates that the person will be incurring at retirement. And again, these calculations involve guesswork and incomplete information. Very often, for example, we can't really calculate capital gains accurately because the clients don't have their basis information. And if you don't know the basis, you can't really accurately calculate the capital gains. Excuse me. So let's talk about some other tax consequences, tax implications in the program. We have some very cool reports. So we're going to go into the what if pages. So I'm in the analysis section, what I call the playground or sandbox. I'm going to be in the what if part, and I'm going to more under these are for support calculations. And we have a report that will tell you which party should claim the children as exemptions to minimize combined taxes. This is always, not always, but often a point of contention in cases. Remembering, of course, that the Tax Reform Act of 2017 eliminated the value of tax exemptions until the 2026 tax year. So right now, the exemption itself is worth zero. Some people are still arguing about it as if it has a value. other people understand that it's worth zero, so think that there's no value to it. But children, remember that cases that we're doing now, those kids will probably still be dependents in 2026. So it's worth considering. Also, the child tax credit goes with the dependent exemption. Obviously, that was a big thing last year in 2021, less so now. It does phase out at higher incomes, and the refundable portion is lower now. But we have the child tax credit is included in this best use of the exemption analysis. We can look at federal only or federal and state. And we have several different ways of looking at it. You know, the first question is it better for my client? Is it better for the family overall? Is maybe the second question. Maybe those are reversed depending on how you approach things. And then what impact does it have on the other party? So here we can see that Taylor's tax is the same, whether Taylor claims the exemptions or Blake claims the exemptions. Blake's is slightly lower if he gets to claim the exemptions. So we're only talking about $1,600, almost $1,700. Is that worth arguing about? And in some cases, if that number were higher, it might be. Clearly, it makes no difference to Taylor in this scenario. So these are things that you can look at. Remember that we have this great report that shows the difference in the value and have a nice graph that will sometimes be more disproportionate than this. But in this case, there's a small difference. So again, you know, if you're charging $500 an hour, how many hours do you want to, do the clients want you to argue about the tax exemption when they're going to save $1,600 a year in the current year? And then we can look at next year as well and see what the difference is for next year. Okay. Now, remember that there are other child-related tax credits that do not go with the allocation of the dependent exemption. The EITC, the Earned Income Tax Credit, nope, not related to the dependent exemption. The child care credit, nope, not related. College-related ones, opportunity and lifetime learning, not related to who has the dependent exemption. They are related to who is the majority time parent, more than 50% of the time. So then we have another report that I find very helpful. It's a little late to worry about it now, because if you haven't decided whether people are getting divorced this year or next year, you only have a couple of days to figure that out. But we can look at best filing status. So this is great. I start using this probably in about September, August, September. Am I going to try and get this case done this year? Or is there a benefit for them to stay married filing jointly? And in this case, it tells us that if the parties are still married, their best tax status is married filing jointly. And they can save $40,000 over married filing separate or separate and head of household. They'll save about the same. And then to minimize the combined tax, they're going to stay married. Okay. And we have a whole explanation report, which will give you the various options and the numbers associated with them and a whole report. What I like to do is PDF or print this report and send it to my clients and say, take this to your accountant and decide. Generally, I do it before December, 27th, when I only have 4 days to get it done. In the meantime, this also can be handy for disputes over filing status in future years, in the next year. So let's say we're now into January, February, and they're arguing about whether or not to file jointly. Making sure that you are looking at the 2022 tax year. So you would have to change the assumption about the tax year. You can generate a report that would show what the difference is in taxes, perhaps for a dissipation argument, or perhaps for persuasive effect, to get them to file jointly, maybe with an indemnification agreement, right? We do that a lot. Okay, you have a question. Is there a way for both parents to file head of household if custody is 50-50 for 2 or more children? There is, and Anna, you can type out the detail. You could have one parent have more than 50% of the time. There is an IRS tiebreaker rule if parenting time is allegedly 50-50. And I will point out that there are 365 days in a year. And so it really isn't equal number of overnights, unless you're getting the kid up at midnight on one night and switching households. It's slightly more than 50% for one who's going to have the majority time. But there is a tiebreaker rule, which would give the majority time parent status to the higher wage earning party, the higher earner. And that higher earner could be phased out of tax credits and so on. So you really want to be careful about doing that. But you could have different parenting time schedules for the 2 children, where one parent has at least one more overnight each year than the other parent. Okay. But it will go by parenting time schedule, not by agreement on who gets to be head of household, because it's not something you can agree to. It's a status. You either have the status or you don't. You're either eligible or you're not. Okay. Let's talk about alimony or maintenance, spousal maintenance. It is still taxable for state purposes in certain states. It is also still around if you're modifying a pre-2019 maintenance order. So our maintenance provisions, our maintenance calculations will show taxable or non-taxable. So when I enter data and I go into support maintenance data, at the top of the page, we have a selection for spousal maintenance. And here we're in New York, so it is taxable for state purposes. So it will automatically be taxable, but you could change it if you were in a different state, or if there was an agreement for it to be non-taxable. So where does this come into play? Of course, it comes into play if we're looking at a present value of tax consequences. So we have a maintenance present value report. Where did we move it? Okay, analysis. Maintenance present value. And this will take into account tax consequences. And here you can see that the state marginal rate is included automatically. A blue colored field is a calculated field. And there are, let's use actual spousal maintenance. Let's go back into actual and let's make it go a little longer. Let's say it's going to end in 2032. Okay. So we're going to use actual spousal maintenance of $33.74 a month. Let me update. And that's going to give us a present value. So then we can also do not the actual, but another amount, and we'll update the graph here. And because their taxes are the same for both parties in this state, their present values are going to be the same. the only real variable, and in states where alimony is not deductible or taxable, the only variable is going to be your pre-tax interest rates. So what I sometimes like to do is play around with different rates to see if I can get a number I like better. And that is using a 20-year treasury bond rate. You can change it as you see fit. And again, that will update when you update the program, or if you're using the cloud version, you can make that update by just entering in the new information. So I can show two different values here if I'm using different pre-tax interest rates. If I'm using the same rate, it's going to be the same value for each of them. So that's one use of taxes for maintenance. Also, if it's going to be taxable, we can look at the balance incomes, and that would allow me to, I have to change the filing status because we are, head of household. Okay, so now if I go to balance incomes and look at maintenance options, it's going to allow me to, and of course, now my program is frozen. Am I coming through okay? There we go. If I go to balance incomes, come on. I am lagging seriously. I hope this is coming through okay. There we go. I can look at my amount of maintenance needed. This is going to look at after-tax income. So if maintenance were taxable, it would take the tax consequences into effect. Or I can look at balance incomes, which also looks at tax consequences. And I can look at the desired split of after-tax income between the parties. And there are also options down below. And for those who are FinPlan switchers on this webinar, we have a report that will be familiar to you in terms of our expanded report. And there are options. We can keep child support in sync with the spousal maintenance. We can include living expenses as well. So that is going to come through also. Now we have lots of alimony recapture, spousal maintenance trade-off, maintenance after tax, all of which are no longer an issue unless you're looking at spousal maintenance after tax for state tax purposes. We have a lot of tax detail reports in the program. And if we go into reports, more reports, we have over 60 reports. And there is a section here that will show you backup reports for tax calculations. We have tax detail for AGI, adjusted gross income, deductions, bottom line, childcare credit, taxable income, all of these reports, which you may find helpful. And also in our income and expense and net worth projections. As I showed you earlier, we're going to utilize taxes based on the assumptions of future income, expenses, liabilities. There are assumptions for the program, and same page that we looked at before for the tax year. This also has assumptions about rate of return and so on. And if we click on the help button here, you'll see that accumulated savings is not return on exact assets that currently exist. You would specify those on an asset by asset basis where the asset is entered. So that will be in your entered data. And we go to your assets and we can, let's go to the quick view, and we can look at each asset in more info and put in the annual income and any rate of appreciation. And then that will impact those projections as well. You can go out up to 50 years again, in the assumptions or in the reports, more reports, there is a number of years to show in financial reports. We can go from 1 to 50. And you can, and that's also on the lawyer's page, the number of years to use for projections. We will automatically reinvest positive income, automatically liquidates assets to cover negative income and any taxes that are due on those liquidations. This program is probably the most sophisticated financial planning tool with respect to the incorporation of tax impacts on long-term projections. So that is our webinar for today. I'm sure that there may be other questions as you are using the program. Please feel free to always reach out and look at our support options. We have FAQs, training videos, there's program help, and you can always contact us. Takes you out to our website, allows you to put information in an email to us. You'll be in our support queue. Hopefully we get back to you within 2 to 4 hours, or you can always contact either Anna or myself for help with the program. Thank you for attending this webinar today. Really appreciate your attendance here and your paying attention. And I hope you enjoy using family law software and really enjoy using it. Thanks.